Hey, welcome back to the Consulting Mind. Today we're going to talk about why and how the pension fund panic had led to the Bank of England dramatic intervention and the sudden relaunch of quantitative easing program. So, let's start with what had happened. On the 23rd of September, the Bank of England had announced that they're going to use an unlimited bond buying program to avoid the imminent gilt clash. And if you recall, the Bank of England is actually the first major central bank on earth who started the quantitative tapering program, i.e., the major central bank that first used the actively bond selling approach to end the quantitative easing. So, what makes them suddenly to twist their position and to suddenly make a U-turn in this quantitative easing approach? Well, the official claims that this is mainly for avoiding a meltdown in the UK pension sector, and in particular, this is considered to be a material risk to the UK financial stability. So, what are the story behind the numbers? We can take a look at the UK 10-year bond yield overview chart, such that we can have a better understanding on what are the market telling us. So you can first see that the bond yield has actually been climbing since August, which is normal because back then the Bank of England has already announced the quantitative tapering program details about when and how they are going to sell the bond, and also they have been also keep raising the interest rate. So the rising yield is actually normal and I would say quite stable. But then you can see that the bond yield suddenly shoot up to 3.82% on the 23rd of September, which is the day that the new UK Prime Minister announced the tax reduction package. And then you can see the yield peak at 4.5% on 27th of September. You can see that the crisis has been spreading and escalating as reflected by the yield. And then it finally down to 4% again on the 28th of September, which is also the day that the Bank of England announced they are going to intervene with the quantitative easing program. So this is basically how the incident had been involved. So we can now deep dive into the story, and the first starting point is why they are going to do the tax cut at the first place. Uh, the Liz Truss government 48 billion worth of US dollar tax relief package is basically conduct and announced with a good intention that they wish to curb the inflation on one hand, and they also wish to get better preparation on the energy crisis coming ahead, especially brought by the Russian-Ukraine war, and then they also wish to stimulate the economic growth at the same time. But then, why does the market react in such a way that they did not trust the UK government policy? To start with, because this announcement and this policy, this tax relief policy, will likely cost the UK government extra debt as high as US about 500 billion US dollars to overcome and to compensate the loss of tax to be received. And the second one is that this sort of expansionary fiscal policy actually will increase the inflation and uplift the recession risk. And last but not least, it's about the loss of investor trust because since the Brexit, what the UK government has been doing and the way they negotiate the deal and the way they handle with their promises has basically shake and move the confidence of the investor that whether or not the UK government can or will be going to honor their promise. So what about the pension fund? How does them came into the picture in this crisis? Uh, First, we have to talk about a concept which is a mismatch of asset and liability. And what does that mean? Uh, Under a defined benefit scheme concept, basically, what it means is that the pension plan owes the members a liability, a commitment that they are going to pay the member when they are going to retire in the future date, like 30 years after, 40 years after, the pension provider or the pension scheme, the defined benefit scheme, will have to pay them a specific, a defined amount of liability, which is fixed. No matter the interest rate go up or down, no matter they are making an investment gain or loss, they will have to honor the commitment. So this is the liability side. But then on the other hand, on the asset side, they receive the payment or the contribution from the members or from the members' employer. They will have to make investment from those contribution to match the liability. Normally, they will invest it into those fixed income asset type like the government bond, where they will able to receive a very stable income annually from the UK government bond interest. But then the problem is, as mentioned before, the liability is fixed. But on the other hand, the return of the asset, i.e. most likely the interest rate of the bond or the yield, can be fluctuating. So fundamentally, there is a mismatch of the asset and the liability. And then this is where the liability-driven investment come into picture. Basically, this is a strategy adopted by those pension funds to manage their asset such that they can meet the future liability. Like when they are investing in this type of asset, basically they are going to do that with leverage, meaning that they can use a relatively small portion of money to manage the portfolio such that they can get the desired yield, and for the extra proportion, they can actually invest in other asset class in such a way that they can manage the return and the portfolio risk. But the problem is when the yield rise, they typically face a margin call. As mentioned before, they are going to use the leverage. So under this situation, they will have to pay more to the counterparty because the collateral, i.e. the bond, are worth less now. So how does the blow up happen? Basically, it first start with the rising yield. And then when the yield is rising, they do not have the sufficient spare cash to meet the margin cost. And then they have to sell their liquid asset, i.e. the gilts, to meet the margin cost requirement. And then when they are going to sell the gilts, the gilt price fall again. And the yield keep rising, and the cycle, the negative feedback loop, continue again and again and again. So if you imagine tons of pension providers, tons of defined benefit scheme are doing this action, the impact will be dramatic, where there are lots of bonds being purchased, being thrown out into the market, and the yield keep being pushed up. So this is what happened into the market in the end of September. So as a takeaway, the global economy and market has become very fragile and sensitive now as a result of the massive pullback of liquidity and as a result of the quantitative tightening program adopted by different major central banks on earth. What happened in the UK government bond market will not be the only one and will not be the last one. So you have to be very carefully watching out what might happen in different asset classes as well. And on the other hand, the market is also expecting that whether or not the US Fed will be doing something similar to the Bank of England in order to save the some sort of asset class in the future, just like what they have been doing for the UK government bond market. So watch out for the potential movement of different central bank coming onwards. So if you like the episode today, please click the like button and subscribe for me. See you soon. Goodbye.